how should people be thinking about timing right now in the real estate market in 2024? If I want to go buy, what should I know right now?
Real estate has been financed and held and produced cash flow and appreciation for people for the last 50 plus years when interest rates averaged much higher than they are now. So that's the first point, is that it's perspective. But I think the second point is even more important, and that is
welcome everyone to a special episode of the Main Street Business Podcast. This is Matt Sorensen. Today it is my honor to welcome Robert Helms to the podcast. He is the host of the Real Estate Guys radio podcast, TV show. He is a fountain of knowledge when it comes to investing in real estate. He's trained thousands of real estate investors and professionals. He's also a real estate broker. I learned he'd been an appraiser and trained appraisers too. He's just got a ton of knowledge that we're going to dig into today in the podcast. And also, Robert is going to be a speaker at our Alternative Asset Summit, October 24th and 25th, altassetsummit.com. So you can come meet him in person, pick his brain, and he's going to be teaching, of course, how to invest in today's real estate market. So let's get into it with Robert. Thanks for being here.
thanks for having me. It's great to be here.
All right. Well, we met actually at our self-directed IRA summit, and I just wanted to ask you at the outset here, tell me what you thought of that event. I was actually super excited you were coming. We got to meet at the reception there, and events are always a great time to network and meet people. It was great to meet you, and I know you got to meet a lot of our people there, but tell me what your impression was of the self-directed IRA summit.
Yeah, that was a highlight. You know, I'm a big believer in getting out belly to belly, going to events live.
Yeah.
You can learn a ton on podcasts and reading books and all that, but you know, this is a people business. And a couple things really caught me at that event. First of all, just the enthusiasm of the attendees. So obviously, the folks that are going to attend an IRA event are folks that are either interested in that or already pursuing it, but they weren't just sitting there passively taking notes. The conversations at the breaks, all that was fabulous. And then I think the other part is just, you know, despite your being an attorney, you have a great way of just explaining it so people can understand. And you know how sometimes educators try to inflate their knowledge or sound smarter than they are and confuse the audience. But that was not the case. And I had been referred to you by a good friend of mine, and that's always a good start. But when I got to start the morning, just watching you do the overview, it's like clear, wow, this guy understands this. And we've been working in this space for a long, long time. And I will say just the pace of the event, the variety of people you had, I mean, I thought it was fabulous, and I would strongly recommend, if folks haven't been, that they go the next time you do that event.
Yeah, well, awesome. Well, Robert's going to be actually at our Alt Asset Summit coming up October 24th and 25th. He's going to be one of the experts we'll have on the panel, because I know self-directing, I know business, but I like to bring in the experts on real estate. That's, you know, Mark and I, many of you know, we invest in real estate ourselves, but we do not profess to be experts on that. Hence why we have Robert here today. This might be a little bit of preview, a good little summary here of real estate investing. What I want to do with Robert today, and what I asked him is, like, can we talk about buying rentals in 2024? And let's get very specific on buying rentals. Robert did an excellent podcast episode on his podcast, Real Estate Guys Radio, on stages, cycles, and seasons of the real estate market. And I thought that was really interesting to get some takeaways on how to think about investing. I kind of was summing up like when to hold them, fold them, or kind of go in when it comes to real estate. Then I said, let's get super specific though about deals that you're seeing right now. And so Robert promised me he would do that. And so we're going to get into that on the tail end here. But let's start at the beginning, Robert, and just like timing. How should people be thinking about timing right now in the real estate market in 2024? If I want to go buy, what should I know right now?
I think the elephant in the room is not only the increase of interest rates, but just how quickly they jumped up on us. I think a lot of folks are surprised, and therefore they don't know what to do. Like 2 years ago, I could have bought this awesome rental house and it would have made a ton of sense with 20% down. And today it doesn't, because the loan has doubled. So
Yeah.
that's the big challenge today. Now, I think before you just say, well, that's it, we're going to have to sit on our hands because rates are too high and are going to come down. A couple points of perspective. Years ago, we did an event and I pulled up an old presentation where we had a spreadsheet of the interest rates and home appreciation from 1977 to 2001. That's a pretty big period of time, right? That was
Mm-hmm.
the thick
Mm-hmm.
of my early real estate investing. And I bought my first house slightly before that. And just looking at the numbers and the interest rates, it was crazy. Over this, more than 20-year period, the average interest rate was about 9.5% on a single family rental home. Now,
Right.
there were years where it was 12 and 14, and there were years that it was 8 and 9, and there was only 1 year in nearly 25 years that it was under 7. So the point is, people today think that 7%, 7.5% is crazy high. And maybe compared to the last dozen years, it is. But we take a longer approach. Real estate has been financed and held and produced cash flow and appreciation for people for the last 50 plus years when interest rates averaged much higher than they are now. So that's the first point, is that it's
Mhm.
perspective. But I think the second point is even more important, and that is we have a housing shortage. We don't have an immediate, terrible, awful people in the street housing shortage. But if you look at the numbers, our population is increasing. Now, there are a lot of folks who say that's going to curtail itself here in 20 years. But in the meantime, we're underbuilt. Both single family homes and apartments are underbuilt. Folks see that. And so you see developers bringing new product to bear. You have the build to rent community, you have new apartment starts. But even at that pace, we are running out of places for people to live. So there's a real demand. And because of these high interest rates, it's been exacerbated. People are not building, they're not buying, they're not putting more rental inventory to work, and they're trying to figure out ways to repurpose big retail or office product, wherever it may
Yeah.
be. And there's a real need. So I think if you study and pay attention, you can figure out how to be part of the solution to that problem. So I think it's not a bad time at all to be buying rental property.
All right. Tell me about, just give me a little taste here of the stages and cycles and seasons of real estate, if you could.
Yeah.
Um, and where do you feel like we are now? Like, how should I be thinking about it now in 2024?
Yeah. So the stages of a market are really a market from start to finish. And that is less about timing and more about just the way a market gets built out, works over time, creates
Yeah.
housing and jobs and all the
Is it a
things.
growth market, established or in decline
Yep.
type feel? Yeah. Okay.
Yeah, and obviously different markets hit those times at different times. You see a
Mm-hmm.
gentrification market where it was an old, awful,
Yeah.
dilapidated, outdated property market, and all of a sudden it's become the hot, hip new thing. That can change the stage of a market for sure. But if you overlap on that, kind of that the growth and equilibrium and decline and revitalization, that would be the stages of a market. You overlap that with cycles. And cycles do repeat. So the cycles are really fascinating to watch. They don't all work in concert, and different markets, physical geographic markets, work at different times. Demographic markets, who it is that's buying property and why, that is a cycle. And then you have probably the cycle people talk about the most, which is in the product type, single family, multifamily, industrial, where are we? And so a cycle is simply the fact that over time, things like the cap rate change as well as the returns. And so when we look at the cycle, we want to kind of understand, okay, where is this market that I'm interested in? I like the single family house market in Jacksonville, Florida. Okay, so where is that market in terms of its cycles? What's been coming before? What do we see next? And there's so many variables that it can be a little daunting at first. But again, through study, you can start to figure this stuff out. And the great news is most of the information you need to figure out where a market is in a cycle is readily available. especially in the United States. Now, we have properties in a whole bunch of places, and we have listeners in 194 countries. So it's not
Yeah.
true everywhere. You don't always have easy access to things like jobs and infrastructure and net in migration. But in the US, we do. And so we can take all of the markets that are out there and narrow it down to a handful of markets that make sense based on where they are in the cycle. So there's markets that are right now kind of topped out, meaning if you think about a market that you've invested in or that you know of, or maybe where you live, it could be that we're starting to see fewer sales. Prices are starting to come down a little bit. Days on the market is growing, right? That's one indication of a cycle. Then there can be another market where the opposite is true, where you have a waiting list for tenants, where rents are going up so high that the local apartment association is cautioning landlords not to get greedy. When we see sometimes the laws and local jurisdictions change to protect either tenants or landlords, that can give us a clue. So you can't say, well, how's the real estate market? Because there isn't just one real estate market. There are markets right now I would stay away from, and there are
Yeah.
markets right now that I'm doubling down on.
Mm. Kind of like the hand you're dealt too here. If we stick with the metaphor,
Yeah.
hold them full of it depends on the market or depends on the hand you got right now. Um, okay, well, I think this is really important because as we've been thinking about investing in real estate, and Mark and I did a podcast a while ago about analyzing a rental property to try and just get very specific on the numbers. We're very analytical, of course, as business and tax lawyers at heart. So, but I think understanding these cycles is really important because that's going to tell you where your investment's going. You know, it's kind of like Wayne Gretzky's like, don't skate to where the puck is. I skate to where the puck's going, you
Right.
know? And so when you're investing in real estate, we want to look at where's that real estate going. Now, you don't always know for certain, but understanding this and getting smart on where things are in terms of the cycle is where you can really win in the future. Because if you know those factors, like you're talking about, job growth, net migration. I mean, what does that tell me? That tells me there's going to be more demand for the rental, you know, right? And so with more demand is gonna increase my rent growth and probably appreciation of the property in terms of people wanting to buy and live in those communities or that in that market. So um, even as we're talking about this is where my mind's starting to go right now is I think this is super helpful to understand where your investment is going to be going in the future.
That is critical. And I think there's two real shortcuts. So, we could spend hours talking about all the ins and outs of
Yeah.
demography and all that, but I'll just give you two hacks, if you will. If I look
Love it.
at, say, every state in the United States, and I've got my dart and I'm trying to throw the dart at the dartboard and decide where to invest. The first thing you have to understand is you may not live in a place that makes sense to invest. So I always say live where you want to live and invest where the numbers make sense. If you live in a place that has great rental property, well, awesome. It makes it easier for you, but you're not limited. Nothing says, well, you can only invest 100 miles from your home. It's not like that at all. But if we took all of the markets and we just did two overlays. The first is net in migration. So in every market, every day, people are moving in and people are moving out. And the net in migration is simply saying which markets are there more people moving in than moving out. So on a weekly or monthly basis, we're seeing an increase in the population. If I just stop there, that's going to give me a better than average opportunity to find a market where that demand you're talking about is
Mm-hmm.
increasing, not just in terms of the need for housing, but what people are willing to pay for it. So that's the first positive net in migration. What that does is it eliminates about half the states because
Yeah.
many of the states are losing. And it's not that they're necessarily losing people. It's that when that person moves from market A to market B, market A lost the tenant or the owner, and market B gained it. So if you multiply that times the millions of people that are moving, then you can start to see those patterns. The second thing is tenant landlord law. So some states are much more favorable, you know this as an attorney, to
Yeah.
tenants and are going to err on the side of the tenant's rights, and other markets are more respectful of landlord rights. It's not right or wrong, but it's easy to tell. So if I can focus on the markets that are pro-landlord and that have net in-migration, I have just whittled down the playing field to a much more manageable number of markets. Now, it's still a big number of markets. So once you get that figured out, now I think you really have to start studying. Years ago in my appraisal class, I had a woman come up and she said, I'll have you know, I'm studying 18 different real estate markets across the United States. And I said, I'll have you know, you're wasting your time. And she looked at me. She's like, that's not the answer she was expecting. Well, I believe that even right now, when I invest in a lot of places and a lot of different products, I believe you can only know about a half a dozen real estate markets well enough to make investment decisions there. So if you're the one running the ship, if you're not just handing your money to a manager, if you're the one
Hmm.
out there looking for the properties that make sense, then you have to get your mind around the market. And you do that working with a team, right? You got to have boots on the ground. You have to have brokers and agents that know the market. You certainly need property managers that do. You're going to want an attorney that understands, right? So you build up a team that can help you. And that's the great thing about real estate investing is it is a team sport, and you
Hmm.
can continue to scale your business once you find a great team and a great marketplace. And I'll say one more thing before we leave the topic, and that is in the stock market, I can jump in and out really quickly. Real estate's not like that. So we like to say that you get married to a market, meaning that I don't just, I'm holding them a lot more than I'm folding them. So
Yeah.
rather than just keep my cards every time I'm thinking about a marketplace, I want to be more strategic than that and decide, are there enough sustainable drivers that it makes sense to me to pull the trigger, buy a property here? And then if I buy a property in the market, I'm expecting to continue to be in that market. I'm not going to buy one and see. I'm going to make sure I made a good decision. I'm going to get the feedback, might help me adjust my personal investment philosophy a little bit, but I'm going to only be in a handful of markets. So if I wanted to own 50 houses, I wouldn't own one house in 50 states. I might own 10 houses each in 5 different states.
Okay. Well, let me, and everybody just hang tight here because we're going to get to some specific examples, 2024 deals. Robert's like, I even got one, my son that's 18 years old did. So we're going to get into that here in a second. But I want to give some context for this and just some additional thinking here. So let me just comment on the landlord tenant law thing. And I think that's really important because I think sometimes people are like, but why is that? What does that mean? And let me just tell you from the lawyer, Matt Sorensen, who's also invested in real estate and had to evict somebody. This is a big deal because this is the number one thing for me with respect to this is eviction, right? How do I get someone out when they're not paying? Because that's a huge cost. The mortgage company that I got the loan for to buy the property isn't going to excuse my payments, right? I'm the landlord. I got to pay that regardless. And if I was counting on the tenant to pay me to cover that mortgage, well, guess who's left holding the bag? You, the landlord. And it's most likely if you win in court and get a judgment against that tenant, you're not going to be able to collect, right? And so it's very hard to actually collect on those judgments. It's kind of like you're throwing good money at bad money and lawyers' fees. And this is a lawyer, me, I'm like, don't pay the lawyers more and throw good money at bad money. And so when you're looking at what type of cash flow you can have, that's where you really get stung in these tenant friendly markets, and why the more landlord friendly markets that are more clear cut, easier to evict, quicker timelines and process, because you're the one on the hook until this thing all goes all the way through full cycle. That's to me is the most critical component on that. So all right, well, let's hit some of these markets here. I know we've talked about it and unpacked it. We've talked about you want to get in a good market, of course. Yeah, but where are you looking right now, Robert? And I don't know if you want to start with the deal with your 18-year-old son, but I thought that was pretty cool. You got an 18-year-old son that already bought his first rental.
Yeah, let's start there. My son is now 19. He bought the property just as he was finishing up his 18th year, if you will. So he had that deadline looming. But a couple things happen. When you're 18 years old, you're not going to be able to qualify typically for a conventional loan because a lender wants to see 2 years of tax returns. You probably don't have the veracity of income for those 2 years. So the first thing is you got to be a little creative about how to do it. He got the bug. He's been hanging around us for a long time. It was not me telling him you need to buy a house. He came up with the idea himself when he was 16. He goes, I'd like to buy my first house by the time I'm 18. It started with, Dad, how old were you when you bought your first house? And I said, I was 24. He said, well, I want to buy my house at 18. I'm totally supportive of that, but just know that's going to take a little bit of work. So a
Yeah.
couple things. He earns some money, but he doesn't earn a ton of money. He's got a decent W-2 job, which he strategically went and got, one that had flexibility so that he can shadow me, follow me around to conferences and things and
Hmm.
spend time really understanding real estate, but still a job that pays him pretty well that he enjoys doing. But the down payment is the big hurdle. So as soon as he got this goal, he started socking away down payment. He started to recognize that when you eat out every day for lunch, it costs more than if you'll make your lunch at home, things like that. So he really did focus on putting his money away. Now, in full disclosure, I'll tell you, I backstopped him. I said, listen, whatever you come up with, that'll be your percentage of the house, but I'll back you for the rest. And it ended up, we each put in about half the down payment. So he was able to put aside a nice sizable chunk. But I'll give you the numbers on this property. And it's not because he's 18 and it's not, because of that. That's just the context of the story. But the
Yeah.
numbers had to make sense. So he kind of did some research on three different markets and ended up with a market that we like, but there's 4 points that the real estate guys like to talk about. There's you and your personal investment philosophy, who you are as an investor, and everybody's different. Once you figure that out, and that's a process, then you look at a market or markets that make sense for that philosophy. Once you find a market or markets, now you got to find a team or teams that can help you. And once you have teams established, now you buy a property. Too many people start with the property and they didn't think about the other things, which is why
Yeah.
there's a problem. We say there are no problem properties, there's only problem ownerships. So he looked at a few markets and he settled on Memphis, Tennessee. So he bought his first property in Memphis, Tennessee. We don't live in Tennessee, but Tennessee is a landlord friendly state. Tennessee does not have state income tax. Tennessee is a growth market for mostly blue collar employees, especially in Memphis. So in Memphis, you have distribution, right? The FedEx airport every night, the regular Memphis airport turns into nothing but boxes and parcels and pallets. And it's incredible. And the jobs around it, you've got folks that are making really decent wages, but because of the part of the economic sphere they're in, they just don't seem to be able to save up 20% or 25% to buy a house. So we have a lot of lifetime renters there. So it's a high rental market and a lower ownership market, which makes opportunity. Now, in that market, we have some folks we've been working with for a long, long time, and this was a huge shortcut. So my son Ethan and I flew in and met with our friends Terry and Liz, and they spent a half day with us showing us around the market, the sub-markets that they invested in, and then what they do is they find older houses that need work, and usually a lot of work. And they have full-time crews and a giant warehouse of materials, and they go and completely refurbish these houses. New roofs, new water heaters, all new kitchens and cabinets. These houses are beautiful when they're done, and they have in-house management. Now, for Ethan, that was important because he doesn't live in Tennessee. And so his house, I'll tell you a little bit about the numbers here. So his house was $131,900. So depending on where your listeners are, people may be thinking, wow, that's not much of a house. I will tell you this, whatever your mind just went to in terms of what the house looks like, it's prettier than that, especially once all the
Hmm.
work's done. It looks beautiful. And the level of tenant in there is a pretty strong tenant. So what my friends do is they create turnkey opportunities rather than Ethan having to go in and fix up the house and figure out contractors and all that stuff. They did all that work, and because they have property management, they put a tenant in the property. So his property now, he closed on it the day before he turned 19. It's a 3-bedroom, 2-bathroom house. The income, it's 1,236 square feet. The annual property taxes in Memphis, $861. His rent is about $1,100. Now he's got a 2-year lease at that amount. Now, whether or not the tenant stays for 2 years because they have a lease, that's always subject to interpretation. But these folks have developed a really great reputation. Just to point on the curve, they manage over 4,500 houses in Memphis. And there, for the last 5 years, they have not dipped below 97% occupancy. So that's a pretty good sample size and a pretty
Mhm.
good length of time to say, okay, they know what they're doing in that regard. Because your two biggest enemies in buy and hold real estate are vacancy when no one's living there and you're paying the mortgage, and turnover, what it costs to get the house rent ready. So the fact that he closed with a tenant was awesome. Now, it is not, if you bought this property with a 25% down investor loan, your average cash flow would probably be about $350 a month. And on a purchase price of 131,000, that's a pretty good return right there. But again, Ethan was not able to use a conventional loan, so he had to find another route. And he got a great loan that required 40% down. So he put 20% down and I put 20% down. He put
Okay.
40% down. That did a couple of things. That lowered his loan amount. The interest rate he paid was higher than folks might want to pay, but I still think pretty good at 7.9%. So 7.9% loan, 40% down, 60% loan. And here's the kicker, it's amortized over 12 years. So obviously the cash flow is not going to be as strong. His cash flow on this house isn't $350 a month, it's about $25 a month. But the big thing, and this was a awesome education point for my son, is he doesn't need cash flow. He's got a job. He's got
Mhm.
money in the bank. What this allows him to do is to own free and clear this house in 12 years. And who pays the mortgage? Not him, the tenant. If he
Yeah.
does it right, and if he continues in this property, and his goal is to buy at least one a year, then by the time he's 30 years old, he has a free and clear house. And then when he's 31, he'll have two free and clear houses. And when he's 32, he'll have three free and clear houses. It'll probably go faster after that. So the numbers made sense. The market made sense. But that team part, you can't just pick a name out of a hat when you go to a marketplace. This was a company we had worked with for 15 years. Hundreds and hundreds of our real estate guys listeners had purchased through them, and we have not once got a complaint. So that's
Mhm.
pretty good, right? Of all the people you could invest with, that's just kind of a little shortcut. But I let him run the whole thing. Like if he had a question, he could come to me, but I encouraged him instead to take his questions about property management to the property manager, take his
Mhm.
questions about closing to the closing attorney, right? They know a lot more about real estate in that jurisdiction than I do.
Yeah. I love this example because it's so it makes the property so approachable, right? I mean, and I get a lot of clients of mine that are like, instead of buying $1 million property, they go buy 6 or 7 of these,
Yeah.
and because they actually cash flow great, they're not as sensitive to the market ups and downs because they're such at a price point where it's like you have to have housing and rent at those prices. It just doesn't go much down like maybe $1 million or $2 million property can go up and down a lot more. There's a lot more volatility on higher price points. And so I like this because it's approachable whether I got a lot of money and I'm looking to invest, or I'm 18, 19 years old trying to buy one.
Yeah.
And so let me hit a couple points on this that I think is important. I know you really hit property management, and for me, I bought kind of a turnkey rentals just like this in Indianapolis, where it is and here's a couple other things I've liked about that is um, getting the property fully rehabbed before a tenant goes in is very nice.
Yeah.
The tenants are going to love it. It's a newer property to them, it's like it's updated, and that's actually hard to find, for a lot of people that are least renting single family homes. It also means your costs, unexpected costs that could come out of the woodwork, are low. Stuff's updated, right? Because you got to factor that in as a landlord too. You're stuck with that as things need to be upgraded. You got to replace the flooring, or you got an AC unit that goes out. So that I love the rehab of the property on the front end. But also having a property manager. And one of the lessons I learned, and one of the mistakes I had on a property, and I shouldn't say mistakes, just kind of like, I had a bad cycle, is I had a couple tenants that just back to back just were not great.
Yeah.
And it cost me, right? I had some wear and tear costs. I had to withhold their security deposit to repair it, go out of pocket a little bit to fix it up before the next one. Then the next one, I felt like I repeated the same dang cycle, and they're out within a year, they don't renew. And then since then I've had much better success on this specific property I'm talking about. So, but getting that good property manager that's going to screen them properly, that's going to get into the details, that has a good occupancy track record. I mean, 97% outstanding. Look at any of you real estate investors right now, look at your portfolio. If you had 97% occupancy on your rentals, that's pretty great.
Yeah.
But these all matter too. But let me come back to, let's go with this at a 20% down. You said that was $350 a month cash flow, which I think is outstanding in this market right now. And this is 2024. I mean, we're listening to this in 2024. What was that rate though that you were quoting on a $350 a month cash flow?
Yeah. So that's based on a rate of 6.35%.
Okay.
So which would be a rate that they have in their local market for someone that has a FICO score of 720 or above. So if you have traditional financing ability, well, then you probably want to take advantage of that. They have this other program where you can they have a lot of folks that buy from other countries, 16 or 17 other countries. So they originally designed the program that my son did for someone that wasn't verifiable from a US point of view when it comes to lending. So 40% down at 9.9% interest. Ethan snuck in under the old program, which is at 7.9. And how that works is they just had a commitment of a big chunk of money from a local bank, and they could get those funds deployed into these houses based on an asset-based loan. So you don't have to have traditional credit or income or any of that. And with 40% down, you can see why. But the typical investor out there, obviously, if they are trying to invest using the retirement account, they could buy for cash, and then they would have plenty of cash flow, or they could get one of the loans that is available, and this would be a loan that would be available to an IRA buyer, but it just requires a little more down.
Yeah. Okay. And that's common. We see that a lot. These are kind of like debt service coverage ratio loans, DSCR. Yep. Maybe for the self-directed retirement investors, it's a non-recourse loan. You're not guaranteeing it. It's not based on your credit. Kind of like your son. He didn't have to have the tax returns. It's about the property. They're lending on the property itself. What's the rent's going to be? Okay. Well, let's you kind of went into the detail on Memphis, good jobs, strong renter market with higher wages, growing migration. Where else are you seeing good deals right now in terms of single family rentals for investors?
So we like Florida a lot, and Florida's very tenant landlord friendly. Florida also no state income tax, but big job growth and net in migration are huge. So it's a good, friendly landlord place to own, but we're also seeing a big increase in jobs, which brings in population. So the other example I have is a property. It's a single family new built home in Jacksonville, Florida, actually a suburb of Jacksonville. And we do these field trips into markets, and we're about to go to Jacksonville. So I asked the folks there to send me an example, and this is a pretty interesting property. What's great about it's in a town called Citrus Springs, Florida, and this is a brand new property. So it's under construction as we speak, and it's 3 bedrooms and 2 bathrooms. It'll sell. The listing price is $289,900 for a brand new house. Now, what's really cool about it is because these are build to rent, meaning that this developer specifically builds to a caliber and a quality that will attract renters. And just like the folks in Memphis, they have a property management company, big property management company. So it's important that you don't ask the realtor how much the rent will be. Always ask the property manager. The realtor go, "Oh yeah, we get $1,200 a month," and the property manager goes, "975," right? Because they have to
Yeah.
deliver that. So these guys are both a development company and a property manager. And so they've done a really cool thing on these new build houses. They're able to secure financing in much the same way as my Memphis friends by committing to a bunch of it and essentially buy down the loan rate. But they do that without changing the price of the house. We could spend time on that if you want, but this is a loan that gets bought down by the builder to 4.75%. So your typical investor would be able to qualify for this loan. They're going to put down, let me see, 25% down payment instead of 20. And that's just because many of their clients have already gotten their first and four rental properties. So 25s, you could probably
Mhm.
do it with 20 if you could qualify for that. But with 25% down, that makes their down payment 72,475. Again, interest rate at 4.75%. So the monthly rent on this property is 1865. And that's not just a guess. They have lots of these properties already rented right here.
Mhm.
And they say the range could be anywhere between, 1750 and almost 1900, but 1865 is the number they're expecting to get. They figure out a 4% vacancy rate. And then one of the things about Florida is the property taxes are a little bit higher. So they've got that figured in. Insurance, which everyone knows insurance has gone up a bit too. Their management fee, which is 8%. Now, that's not a magic number. Some property managers charge 6, some charge 10, some charge 12. It just depends. You never want to pick the lowest price. You want to pick the one that can deliver the results. What these folks do is they would charge a new client 10% for property management, but if you buy the house through them, then they'll do it for 8% because they love to have that business. And then they have a 75% loan. So that puts their, let me see if I have the payment in here. Um, don't see what the payment is on this loan. I do apologize. This was sent to me during our recording because
Mhm.
I wanted to get something super, super current. But we could figure that out based on the rental rate. And it's got no HOA or any of that, but it's also a brand new property, which means there is a builder's home warranty. And, obviously tenants like brand new. You only get to have a brand new property at first. So you want to buy with the idea that, hey, I'm going to hang on to this thing for 10 or 20 or 30 years. But brand new, nice neighborhood, property management, and the lower interest rate than you might get otherwise. So both of these illustrate, both of these case studies, if you love Jacksonville, Jacksonville also has great diversity of jobs. It is another shipping port, right? It's got the river and it's near the ocean. So that's a big part of their business, but they also have several Fortune 500 companies. They have professional football team, right? A lot of different reasons that jobs are created in the marketplace. So very robust marketplace. But property tax is a little bit higher. So you always want to take that
Mhm.
into consideration. So what I think both these cases show is that rather than say, oh, I'm going to buy a house somewhere, if we drill down to specific markets where there are good teams that have been proven, where you can get loans that maybe you couldn't get elsewhere, where you can find property managers that have high occupancy and a good track record, right? That lets you change the average into your favor. No matter how good I am at picking stocks, when I buy a share of stock today, the price is the price and there's nothing I can do about it. But with real estate, we often can find a better than average deal just by looking a little bit under the hood.
All right. Well, let me just hit some of the numbers there. So let me make sure we can get this one kind of built out. So if
Yeah.
I got the home price is 289,000, I put 25% down, 30-year term on the mortgage, interest rate 4.75, which is so critical to why this property makes sense. I
Yeah.
think. And we're that's going to put approximately 11,000 or sorry, $1,130 a month in terms of a mortgage payment,
Yep.
which, you still got your property tax, insurance and stuff that you need to add into that. But at a rental rate you had of 1865 approximately a month rent, you can start seeing how this type of a property can cash flow. Talk to me how these builders are able to do this buy down of rate right now, and how you can get that 4.75%. You kind of see it in the home buyer for individual buyer market. A lot of builders are offering that type of incentive. How are builders able to do that? Maybe you can explain and break that down a little bit.
Yeah, so typically anybody could get a rate bought down by paying extra interest points up front, right? Interest is not only the interest rate over time, but the points and fees you pay at the beginning of a loan. So it's possible, subject to legal limits, that you could say, Mr. Lender, if I paid you, instead of paying you 1 point, if I paid you 5 points, then what would that do to my interest rate? And it might bring it down. So what these builders do is really interesting. This one in particular, because of their volume, they've got more than 5,000 single family subdivided lots right now. So they are pretty good size, and they're in about a dozen different markets. So they have the ability to pre-buy, if you will, the money. Money is a commodity like anything else. So when they commit to a big old stack of money, they get a discount, like a Costco warehouse discount, by committing to those kinds of funds. And so these institutional investors are willing to make these loans on these properties because they've vetted the markets and the builder. They know the quality. So it really does feel like an asset-based loan to them, but they are going to have the borrower's credit in the case of a traditional purchase as well. And so they know that they've got a commitment for a certain amount of funds, and that allows them to make the buy down without raising the price. And that's a distinction. If I'm a home builder and I can't sell because interest rates are high, I could raise my price $15,000, pay that interest ahead and bring the rate down. But does that really benefit the buyer? It might, because of affordability, but they're paying more for the property. You might run into appraisal issues and all that. These folks, because they only sell to investors, their average buyer doesn't buy every 4 to 7 years like a home owner does. Their average buyer buys 1 to 2 properties a year. So they literally can take less margin per house and turn that into a lower interest rate. And by doing that, they sell more property. So it's kind of a self-fulfilling prophecy. And it's taken them a little while in this market to navigate, but now they're firing on all cylinders. So you get a buyer who would say, well, I love the new property, I love the market, I like Florida a lot, but at today's interest rates, 7.5%, this dog doesn't hunt. It's going to be negative every month. Well, by just re-engineering the interest rate, now they get to where it's break even or a positive cash flow. And part of the philosophy is a single family home you buy today in 2024, the worst performance it's going to have financially is likely at the beginning. That's the hardest part to make the numbers work, which is why it can be such a great tool to have in your retirement account, where you don't have to think about what you're going to do with that money or how you're going to use that money for many, many years in a lot of cases. But for folks that are just buying either with cash or with one of these loans, it certainly is worth taking a look at markets where you can get this kind of a buy down, because the rate is a big function of your monthly costs. Sure, property taxes and insurance and utilities, if you pay them, often the tenants will pay the utilities, but those are all considerations, and expenses are going up across the board. But interest is the biggest one. So if you could do something to mitigate that, now you're starting ahead of the game.
Yeah, love it. And I think as we started the conversation at the beginning here, that has been one of the challenges in the 2024 real estate market is rates have gone up. But if you can be smart and strategic about what you're buying in the right markets, trying to find the right deals, getting incentives like this, finding opportunities where you can get the lower rate. I mean, 4.75 is outstanding in this type of market. I mean, this is where you can win. And I think as we kind of start at the beginning, hold them, fold them type. This is where you ante up or you go all in, so to speak, where you can find these types of opportunities. And the other benefit I think on this on the pro side is there's less competition.
Yeah, I was just thinking that as you were talking, you got fewer people. So my friends in Memphis, one of the downsides they've had as being doing the business they do, which is buying houses and renovate them, is they can only do so much of that. There's only so much of that inventory that comes on the market. There was a point a couple of years ago where, as much as we loved them and our listeners loved them, they had a year-long waiting list to buy a house.
Yeah.
Wow. Well, investors might endure that because they don't need a house this weekend, but that made it an impediment. And now, just because there is less competition, that wait is down to 4 or 5 months, right? Same thing with the new builds. The new builds used to be you got in contract on the property and then they started to build the house. So it might take you 8, 10, 12 months before you had a property. Today, with this new financing arrangement that they have, these houses are already started, permitted, under construction, and it closes the window on how long you have to wait to get that property in your portfolio. So there's a lot that happens when there's less competition. Across the board, there's less competition, and I think so much of it is just people haven't thought through the numbers. They just assume because interest rates are high, well, this isn't a good time to buy. But to your point, if you'll dig a little deeper, sometimes you can find awesome opportunity. And besides these two examples, you can often find a distressed seller, a don't wanter, someone that we call it lazy landlord syndrome. They've had a tenant in there for 5 years. The tenant is way below market value, but they're not raising the rent because it easily covers their costs. And now they're just tired, or they're at an age where they just don't want to have to hassle with it. Sometimes you can find those opportunities. We often will pick up an entire portfolio from a landlord who is in their 70s or 80s, who's had a great run, made a ton of money, but is willing to let go of the property at a little better price because price is not their main objective. They want to be out. Sometimes they'll carry, right? So I think the lesson is, you can't stop at the first opportunity. You have to continue to look. And if you're willing to put in the time and trouble, you can definitely find great opportunity today or in any market.
Love it. Well, thanks so much, Robert, for being on. What do you recommend people do to start finding these deals, connect with you possibly? One thing I'll tell everyone to do is go subscribe to Real Estate Guys Radio podcast. If you haven't already, go subscribe and start listening to that. One of the great things about Robert and what they're always doing is they talk about education for effective action. Learning stuff and listening is all great, but if you don't take action or do anything about it, it doesn't make sense. And that's one thing that I think Robert's been a good example of. I mean, even listen to, an 18-year-old son going out and buying a rental. That'll give you the kind of idea of the action he takes himself and the listeners in his community that he has. So, but where do people go right now? If they're like, okay, I love it, I want to take action, let's get tactical, what do I do?
Yeah, so obviously education for effective action. You want to get educated on this stuff. We can't do that in 45 minutes, but it could be a great start, right? So all your favorite podcast outlets, wherever you like to listen to podcasts, you'll find the Real Estate Guys. This is our 28th year of broadcast on traditional radio, and we're at all the podcast places. That's a great place to start. Specifically, what we talked about today, you can find out about those markets and those people if you'll send an email to midsouth at realestateguysradio.com, midsouth at realestateguysradio.com for my friends in Memphis, or sihomes sihomes at realestateguysradio.com, and you'll get the information on Jacksonville and the new construction. And what I love about both of these folks is they aren't here to sell you anything. They're not hard closed salespeople. They got a ton of education. And on both of their websites, you can browse through houses and prices and markets. The developers, Southern Impression Homes, they build duplexes, fourplexes, single family houses, townhouses, all brand new construction and all with favorable financing. My friends at Mid-South in Memphis, well, they're mostly single family homes, although they do have some new construction, and they're in two markets. They're in Memphis, Tennessee, and Little Rock, Arkansas. And then there's a whole bunch of other great places on our resource center. But, again, don't overwhelm yourself. Don't start with a dozen markets. That's too many. Start with two or three, and then pick one, and then be committed to it. And then once you're in a market and you've got two or three properties and a good team, maybe you look at another market for diversity. And just thinking through what's important to you is critical. Do you need cash flow? If you do, find a property that'll cash flow. But sometimes you don't need the cash flow, like my son didn't. He would rather pay off his loan sooner and then have a free and clear house. So that we call personal investment philosophy. That's one more resource I'll give you. If you want to go through a 25-minute audio workshop on getting clear on your personal investment philosophy, all you have to do is send an email to PIP, personal investment philosophy, just PIP at realestateguysradio.com. And there's no charge for that. You'll just get a little one-page worksheet to download, and then I'll walk you through what it takes to develop your own personal investment philosophy.
Love it, Robert. Thanks so much for all of those resources. Thanks so much for sharing your wisdom and knowledge today. And thanks for everyone listening. We'll be back next week with another amazing episode of the Main Street Business Podcast. We'll see you then.